Hi and welcome to Swissquote's Daily Market Talk. It's Friday, October 11th. Market sentiment is not very jolly since the latest CPI data from the US printed a set of hotter than expected numbers for September yesterday and raised questions about the Federal Reserve's potentially premature declaration of victory over inflation. So the market reaction was quite mixed to that inflation data. Many don't want to believe that the Federal Reserve may have been wrong last month, but it may have been. Whoops, inflation in the US came in hotter than expected yesterday, both on a monthly and on a yearly basis. The headline inflation is less than expected from 2.5 to 2.4%, while core inflation unexpectedly ticked higher from 3.2 to 3.3% in September. So nothing looks encouraging in that inflation report for the Federal Reserve does. Some actually found a little comfort in the jump that we saw in the latest jobless claims data from the US released at about the same time than the CPI report. So that triggered a period of hesitation between those investors who wanted to believe that the Federal Reserve's focus on the health of the US jobs market could continue even inflation behaves undesirably. And interestingly, some Fed officials seemed alarmingly little concerned in the face of an uptick in inflation even before the effect of the first and the jumbo rate cut from the Fed is felt. But at least Raphael Bostic said that he's open to skipping a rate cut in November. And maybe the others should as well. Because if inflation picks up momentum to the upside, the Federal Reserve's focus will have to shift back to containing it, and that even though it means a weaker jobs market and a slowdown for the US economy and even in case of a recession. That is the mathematical basis of the economic theory. That's as simple as that. So, the market's reaction to yesterday's CPI data from the US was quite mixed. The stock investors, first, they just didn't know how to react really. There has been an initial sell-off in the S&P 500 stocks, then some dip buying, then a sell-off again, and at the end of the session, the S&P 500 ended with a 0.21% loss, which is a surprisingly nice performance given the fact that the data, that combination of higher than expected inflation reports and uglier than expected jobless claims data is simply bad for growth prospects, as it means that the Federal Reserve must deal with inflation first and let growth slow down while it gets its prices under control. So I am quite surprised that the S&P 500 didn't show a bigger negative reaction to the mix of the data, and even more surprised that the US futures are actually slightly in the positive at the time I'm talking here this morning. Now, due today, the core PPI data from the US is expected to print a jump in producer prices from 2.4 to 2.7% on a yearly basis. A hotter than expected figure should at some point in time break the back of the Federal Reserve dose. I mean, the Fed is way too optimistic that it could beat the economic theory and reduce inflation to the 2% target while keeping the economic growth above average. So, all this is to say that I am skeptical since the day I saw the Fed cut its interest rates by 50 basis points, and my skepticism only grows by the day as economic data flows in. Now, in the bond space, the US 2-year yield spiked above the 4% mark yesterday after the CPI data, but the rebound remained short-lived. Here as well, there is quite nothing there among the strong economic data that we see and higher than expected inflation numbers to justify a further softness in the US yields. So the probability of a 25 basis point cut in the FOMC's November monetary policy meeting is slightly higher than a no rate cut chance compared to before the CPI data. So I think that there is room here as well for less dovishness for the Fed when traders get ready to see the truth. as such. The US dollar index was, well, it was bought, then it was sold, then it was bought again, it was sold again yesterday too. Well, and yesterday's trading session near flat after a hotter than expected CPI data hit the fan. But the US dollar bulls have all the reasons in the world today to bet against the Fed. Those as the Federal Reserve members themselves could have, well, their back against a wall with these pretty strong jobs numbers. I'm not talking about the yesterday's jobless claims, but I'm talking about Friday's good job numbers and hotter than expected inflation data of yesterday. So the euro dollar collapsed to 109 yesterday as opposed to the Fed, the ECB rate cut expectations are justified by Eurozone inflation that fell below the ECB's 2% policy target. The pair is better bid this morning, but the price rallies are expected to see resistance near the 109.80 level, which is the major 38.2% Fibonacci retracement that should keep the euro dollar in the bearish consolidation zone and encourage a further sell-off toward the 200-day moving average that stands near 108.75 level. Again, a higher than expected PPI print from the US today could back a deeper dive in the euro dollar before the weekly closing bell and also erode the strength of the US dollar against other peers as some components in that PPI report affects the PCE index that the Federal Reserve uses as its favorite gauge of inflation to decide what to do next with their monetary policy and their rates. Either way, the big bank earnings will steal a part of the investors' attention this Friday, as the big banks will be kicking off the earnings season today. JP Morgan and Wells Fargo will open the dens. Then Citi, Morgan Stanley, Goldman Sachs, and Bank of America will be reporting their third quarter earnings next week and provide some insights regarding the overall health of the economy. Now, looking at the market pricing. The US bank stocks have performed well so far this year. They are actually the second best performance among the S&P 500 subsectors so far this year after technology. Of course, as the Federal Reserve's rate cuts got delayed to the third quarter of this year, while the economic growth in the US remained quite resilient. It's sure that the saving rates of the households and the delinquency rates rose, but that didn't have a material impact so far on the numbers. And if all goes well, the lower net interest income that the banks will experience due to the upcoming Federal Reserve interest rate cuts will be compensated by improved economic activity. That means faster loan and deposit growth. While, on the other hand, a potential delay in Federal Reserve interest rate cuts should keep the interest rate income intact. So, the bank investors have a reason to believe that their bank stocks could extend their gains further in both scenarios. Let's see if the market expectations match the reality on the field, and the earnings reports will tell that. Now, moving away from the stock markets and the economic data a little bit, energy and crude oil deserves the last word of the week, in my opinion, because China will unveil more details about its fiscal stimulus plans on this Saturday, and their announcement should definitely live up to high market expectations to prevent investors' enthusiasm for the Chinese markets from entirely fading. Now, the expectation is a 2 trillion yuan fiscal package. That's 10 times the number that was pronounced by the authorities earlier this week. But happy investors mean happy oil bulls. Plus, the tensions in the Middle East will likely keep oil investors tense into and during this weekend. Now, in numbers, the barrel of US crude jumped 3% at yesterday's trading session on possibility that Israel could attack Iran's oil and nuclear facilities. Now, the US is reportedly trying to bring Mr. Netanyahu back to reason and will eventually avoid an uncontrollable escalation of the tensions in the Middle East. But unfortunately, Mr. Netanyahu has a track record of not listening to what anyone says regarding his military ambitions. Therefore, the short-term risks in oil prices remain clearly tilted to the upside. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.